All right, let's dive right in. We're going to break down the, let's be honest, pretty complex world of startup fundraising into a clear, strategic map for all you founders out there. It doesn't matter if you're just sketching an idea on a napkin or you're already scaling your first million in revenue, this is the modern playbook.
But first, we have to start with the most important question of all, the one every single founder has to ask themselves. Do you really need venture capital? You know, the startup world loves to glorify the big fundraise, but honestly, the answer isn't always yes. And whatever you decide, that choice is going to define the entire path of your company.
And just look at this. This quote really highlights a powerful truth. You can have incredible, mind-blowing success without taking a single dollar of venture funding. This isn't some fairy tale, right? This is a real example. For some businesses, that kind of explosive organic growth proves that VC is not the only way to build something massive.
So really, you're looking at a fundamental choice here. On one path, you've got bootstrapping. That means you are the master of your own destiny. You keep all the equity, 100% of it, and you don't answer to anyone but your customers. The VC path, well, that's like strapping a rocket to your company. It's built for insane, hyper growth, but it absolutely comes at a cost. You're giving up equity, you're giving up some control, and you're under immense pressure to scale fast.
Okay, so let's say you do decide to raise money. It's crucial to understand that it's not just a single event. It's a long journey, a marathon, really, with very distinct stages, and each one has its own unique purpose.
This timeline really shows you that long, winding road from just an idea to becoming a market leader. It all starts with pre-seed, which, is often just money from friends and family to get a prototype built. Then seed is all about finding that early traction, that product market fit. Series A, that's when you prove the business model is repeatable and you can actually scale it. And from Series B on up, you're basically just pouring fuel on the fire to expand and hopefully dominate the market.
And here's the reality check. It's so important to have a long-term mindset. We all see those headlines about the overnight successes, right? But the truth is, this is usually a decade-long commitment. This journey, it really does require the stamina for a marathon, not a sprint.
So, if you're going to navigate this journey, you absolutely have to speak the language of investors. And guess what? That language is built on hard data and very specific metrics. I mean, your passion is great, it's important, but at the end of the day, the numbers are what tell the real story about your business's health and its potential.
So, how do you do it? How do you take your amazing vision and all your hard work and translate that into numbers that scream massive opportunity to investors? How do you show them you're not just another startup, but one of the very few that's going to give them that 10x or maybe even 100x return they're looking for?
Well, it all starts with ARR, or annual recurring revenue. For a subscription business, this is the heartbeat. We're not talking about one-time sales here. We're talking about predictable, recurring income. That's what shows you've built a stable foundation that you can actually grow from.
Next up, your LTV to CAC ratio. This right here is the absolute core of your business model's economics. It answers the simple question: are you spending $1 to make $3 back, or are you spending $1 to make, 50 cents? This single ratio proves whether your growth engine is profitable or if it's just burning through cash.
And then there's NRR, or net revenue retention. And honestly, this might be the most powerful metric of all. It answers a really cool question. What would happen if you stopped all new sales today? If your NRR is over 100%, it means your existing customers are actually spending more with you over time, creating a business that literally grows by itself. How cool is that?
Okay, so you should think of these not just as metrics, but as the secret handshake, the benchmarks that top-tier VCs use to filter every opportunity they see. An LTV to CAC over 3x, that proves your model works. An NRR over 110%, that signals that customers absolutely love your product. And a low burn multiple, which is just a fancy way of measuring how much cash you're burning for each new dollar of revenue, shows you're smart with your money. Hitting these numbers is how you land in the yes pile.
Now, knowing the numbers is one thing, but actually running the fundraising process successfully, that's a whole other game. It takes strategy, it takes discipline, and you have to build momentum. So let's take a look at the playbook. So the whole thing, from the day you start prepping to the day you see cash in the bank, can easily take 3 to 6 months. I mean, this becomes a full-time job on top of your already full-time job as a founder. Every single one of these phases has its own challenges, and if you lose momentum at any point, the whole round could be at risk. Now, this is just a golden nugget of advice from Y Combinator's Michael Siebel. Your pitch, it's not about talking at an investor for 30 minutes straight. It's about starting a conversation.
When investors start talking, when they start asking questions and brainstorming with you, they're not just listening anymore. They're starting to sell themselves on your vision. That's the magic moment.
And you absolutely have to avoid these classic pitfalls. Seriously, investors see hundreds and hundreds of decks. If yours is too complicated, or if you bury the good stuff on slide 10, or you don't have a clear ask, you're going to lose them before the real conversation even begins. You've got to be clear, be direct, and tell a great story.
All right, let's get to the final piece of the puzzle, because it might be the most important. The market you're actually fundraising in today. Because let me tell you, the landscape has fundamentally changed from those boom years, and the rules of the game are completely different now.
First off, you have to understand, AI isn't just a trend anymore. It's a gravitational force. In 2024, companies that are AI-powered captured nearly half of all global venture capital. That creates an incredibly intense focus and a flight to quality, which just raises the bar for everybody else.
And this slide just lays it out perfectly, doesn't it? Back in 2021, money was basically free, and the mantra was growth at all costs. Burn, baby, burn. Today, the focus has swung dramatically to capital efficiency and having a really clear path to profitability. And look at that. The time you need between funding rounds has basically doubled.
So what does this actually mean for you in practice? It means the price of admission is way higher. The median Series A startup now needs $2.5 million in annual recurring revenue. That's a 75% jump from 2021. Investors expect real substantial traction before they're willing to write that first big institutional check.
So all of this leaves us with one final big thought. In this new world of higher expectations, fierce competition, and a laser focus on resilience, you need so much more than just a good idea. You need a disciplined, efficient business that's actually built for the long haul. So the real question is your story and is your startup truly built for this new reality?